Thank you for that introduction. Afternoon, everyone. We're going to lead off here today with Anthony Lee from Altos Ventures is going to take us through a presentation. Then we'll introduce you to the rest of the panelists and have some Q&A. So Anthony, take us away.
All righty, thank you. So let's see. Do a slide thing here. Okay. Thanks. First, a personal confession. I am totally unqualified to talk about investing in the Southeast. This is my first trip to Nashville. Never really spent a lot of time out here. In fact, I'm from northern Canada, pretty far away from here. But there's one thing we do know in northern Canada, and that is ice hockey. And last night, like any Canadian, I went to watch your local hockey game. And you guys have an awesome team here, so I'm going to put on my Preds hat. And my ears are still ringing from the arena. But what I'm going to talk about today, just to set the table for this panel, is what is going on in Silicon Valley and why are firms like these looking outside of Silicon Valley for great investments. So how many of you have seen this show, Silicon Valley on HBO? All right. So if you haven't watched it, because this is a great caricature of what goes on in Silicon Valley. In fact, it's so accurate, it kind of makes me want to puke about my day job. There is a great episode in Silicon Valley called the Sand Hill Shuffle, wherein Richard and Ehrlich go up and down Sand Hill Road pitching their startup Pied Piper. And the more obnoxious they are to the investors, the higher their valuation goes during the show. Now, Sand Hill Road, of course, is the 1-mile stretch of road in Menlo Park, California, near Stanford University, where more than half of all US venture capital is based. And we actually have an office on Sand Hill Road. So why am I here talking about investing outside of the valley? Well, for us as a firm, 9 out of the 10 investments we've made in the last 5 years have come in cities like New Orleans, Portland, Estonia. So we've gone all over the world to look for great investments, and we're very interested to see what's going on here in the Southeast. Now, that's not the case for most of the venture capitalists that are in our neighborhood. If you look at the numbers, the vast majority of software financing has gone to California and mostly to Silicon Valley, despite the fact that the value is often created outside. So if you look at public software companies, most of them are actually headquartered outside Silicon Valley. And if you dive down even deeper into vertical software and industry-specific solutions, you'll see that more than 80% of those companies are based outside the valley. So why is there this disproportionate amount of capital that is still going into companies in Silicon Valley? One of the theories that I have is that while capital is mobile, capitalists are pretty lazy. We hate to get on planes unless there's a good reason to do so. And there's a lot of great stuff in Silicon Valley. After all these iconic private and public internet companies are based right in the valley, either in Mountain View or San Francisco. So it's no wonder that all this capital is going and trying to create the next Dropbox or Google or Facebook. But there's a flip side to all this, which is the fact that these companies set the tone for how startups are run and how much it costs to run startups. So just to take you through a few examples, this is Dropbox's cafeteria. This is the dinner they served a few months ago. I got it off their website. Their corporate cafeteria is a 1-star Michelin restaurant. This is Facebook's parking lot, employee parking for Teslas. This is Airbnb's breakout room. This is Salesforce's new office. And of course, you all know this company. So these kind of perks, these kind of cost structures really set the tone for how startups are run. It trickles all the way down to the seed companies. And as a result, you have these very spoiled San Francisco engineers who now cost $200,000 a year on a fully loaded basis, about half the size of a Nashville seed round, right? So how do you compete with that? Well, one of the things we look at when we fund companies is something we call the efficiency metric. And if we find a company that has raised less money than the revenue they are generating, we think that's a great thing. And we see a lot of these companies here in the Southeast, the Southwest, in places outside of Silicon Valley that have less venture capital. The Valley company, on average, ratio is for a $20 million SaaS company, you're talking about raising $70 to $80 million to get there. So it's a very, very different equation. There's a few reasons why it's better to be out here. And I think the 3 most important ones, and some of the panels talked about this yesterday, is that you are away from all the distraction and craziness of the valley. You can focus on what you're doing, build a great company. You typically can do it for a lot less money, a lot more efficiently. And you've got access to great local technical talent that doesn't leave your company every 1.5 to 2 years. Now, the flip side is there are some things that are a minus about being out here. One is velocity. So there's a certain urgency and velocity to doing work in the valley that you don't always feel when you're not in there. That's related to proximity. So the density of talent, the density of ideas, investors, all this stuff with the connections going on, the coffee shop run-ins, you don't get that as much when you're outside of the valley. And then one of the things that we've had to deal with our companies is senior talent. So when you get to the level of a 10, 20, $30 million run rate company, finding people who've taken a company from that level to 100 or 200 million can be difficult. So what should you do? There's 3 suggestions that I have. One is spend time in the valley. Go visit, go do the Sand Hill Road Shuffle, be nicer about the muffins. You can raise your money there, just as Ken and Todd did yesterday on their panel. You can recruit execs there. More and more people are leaving the valley and going to better lifestyle places and setting up their families here. And then I would recommend you just come back and focus on building a great company. So you can do it without the valley. You don't have to be there, but you have to go through there. So in summary, what I would say is, who needs this valley when you guys have this one? Thank you.
Great. Well, thank you, Anthony, for that. So to lead off, maybe we can go down the line. We've heard from you, but Victoria, maybe you can introduce yourself, and Michael as well.
Sure. Thanks for having me here. So I'm Victoria Fram. I'm the co-founder and managing director at Village Capital. We are a fund that discovers, develops, and invests in the best early-stage entrepreneurs that we think are solving real-world problems. So for us, this is things like healthcare, education, financial services, sustainable energy, and agriculture. We are similarly very happy that 86% of our portfolio is outside of New York, San Francisco, and Boston, the sort of core 3 markets that receive 75% of venture dollars. 2 of our investments are here in Nashville, and we have a couple spread throughout the rest of the Southeast in Georgia and Kentucky and elsewhere. So happy to be here and talk about a lot of the reasons that we're excited about investing in this region and many others that are outside of those core, well-established ecosystems.
Yeah, hey everybody, Michael Gilroy. It's great to be here. I'm an investor with Canaan Partners based in New York City. We're a bi-coastal firm that invests in technology and healthcare. We have $4.2 billion under management, and on the tech side, really span across anything from consumer to fintech to enterprise software, space, and security. We invest in companies that are seed through Series C. So excited to be here.
Great. Okay. So I think 2 of you have alluded to this, but who here has made investments in the Southeast in the last 2 years? And can you talk a little bit about those companies and what got you to say yes?
Sure. So in the way that we think about our process, and it's a little bit different than most other firms, so we actually have a 2-part system. We have one side of our business that focuses on the sort of sourcing and development aspect of building an early stage business, and then the fund side. And on the first side, the way that we go about that process is by identifying communities around the US and internationally that we think have great assets that make them uniquely well positioned to build a certain type of business. So for instance, one of the areas that we focused on is in Louisville, Kentucky. That's a center of our agriculture work. Couple reasons for that. 1, you have the highest density of family farms, and 2, you have great proximity to transportation and logistics infrastructure with UPS and others being based there that help facilitate the movement of food and other agricultural inputs. So a couple of the companies that we've invested in out of the work that we've done in Kentucky, one's actually based in Kentucky and one is based here in Tennessee. The one that's based in Tennessee, you might have heard from earlier today, Stoney Colors, and their business is helping transition tobacco farmers into growing natural indigo that they're using to be a drop-in replacement in the denim industry for what is otherwise synthetically produced petroleum-based dye that has a ton of toxins. So the blue jeans that you're wearing, unfortunately, also have things like formaldehyde and cyanide and other things that you don't want necessarily near your skin or in the water systems that are coming out of processing those garments. So one of the reasons that Sarah's business is uniquely well positioned in Tennessee is that there's a great density of people who used to be growing tobacco and have now found less demand for that, luckily for our public health outcomes. But the growing process is quite similar for the 2, and she's able to transition that labor base and was able to set up a lab that does a lot of the chemical innovation that they have pioneered to get a scalable supply chain for brands and denim mills that want to be able to tell a sustainable American-made story. That's a business that I think is unique to Tennessee and to other places that are transitioning tobacco farmers like the Carolinas and Kentucky and elsewhere.
Got it. That's great. Michael?
Yeah, I probably should have answered first because we weren't quite as thesis-driven with our two investments down here. The first is a company called Cardlytics, which is based in Atlanta. It's a later-stage fintech company. And the second is a company called Bellhops, which is based in Chattanooga. I'll talk about Bellhops because it's one I was involved with personally. And so what we saw there, first of all, from a kind of theme perspective, disrupting the moving industry, which is one of the biggest industries out there with no national brand. And the team here had really built a fantastic consumer brand on both sides of the marketplace, both on the movers and on the consumer side. And they had built a fantastic culture. And so one barrier for us, and I know we're going to talk about this a little bit more later, is you don't necessarily need to be with a company at every stage, but at the seed stage, it's tough, right? And so if we were to see Bellhops at the seed stage, it would have been more difficult than investing at the Series B, where we felt like they had processes in place and we can afford to be a little bit further from where the actual company was headquartered. But I think Chattanooga helps the business quite a bit in two very specific ways. I think the first is customer service. Moving is a very highly kind of customer service touch point business, and the people of Chattanooga have been fantastic, and our customer success scores are constantly through the roof. And then two is just on overhead. They're disrupting what is currently the model of moving is you have a franchise model and you set up operations in different cities across the country. They are centralizing all of that and saving on overhead and then able to branch out market by market. So I think it's fit that business very well.
And did you talk to them about relocating, or how did you think about having another office?
So we don't have another office for Bellhops today. It's something that we've kicked around. We frankly haven't had a need to do it yet. I think we have a team there. The other piece we really dug in on was recruiting, and they have a founder in Cameron Duty, who's one of the best recruiters across our entire portfolio. He brings folks into Chattanooga, and they do not want to leave regardless of where they're from. So I think that is a key thing that we look for in founders in the region.
And you mentioned need there. Anthony, in your experience, not investing in the Southeast specifically, but more generally investing outside of the Bay Area, what are some of the impetuses that you see that force companies to need to open another office or need to think about relocating?
Relocating to the Valley or relocating outside?
Outside their core area, so Boston, New York, the Valley.
So for the companies that we're in that are inside the Valley, it's all driven by cost and access to talent. So it's very, very hard right now for us to recruit engineers when you're going up against companies like Google and Facebook. Not only do they pay very high salaries, by the way, the median intern salary at Facebook is $90,000 a year. That's almost double the US household income. So, those kind of numbers are impressive, and when they've got a star engineer, they will lock them down with a $3 to $5 million a year contract. So that's very hard to compete against, and we find that our companies, as they get beyond, let's say, 200 people in the Valley, they will move outside to access lower cost and better talent. The corollary question, or the flip side, is when do companies want to put an office in the Valley if they're outside the Valley? So, Pendo was here yesterday from Raleigh, and then you had Squid from Chattanooga. They both have offices in the Valley. One's a technical office, I believe. One's more a sales-oriented office. So sometimes you need to access, if your customer base is there, you need to do partnerships there, you need to get into the Valley with an office. The worst reason to put an office in the Valley is because your investor tells you to.
Yeah, no, that makes a lot of sense. Are there types of companies that you've seen, Victoria, that you felt this just makes more sense as a Valley company? If it were relocated or if it were based here, I would be incrementally more likely to invest in it?
No. I was trying to think, as we've sort of been going through these questions, of instances when we've come across that, and I wholeheartedly agree with Anthony's comment that we have had portfolio companies of ours who've gotten to a Series A stage, and it's been one of the requirements of a new investor that they've been talking to that they would need to either relocate or open an office, and they've walked from that money. And I think in the handful of instances when that's happened, it's absolutely been the right decision for them. So we have no examples in our portfolio right now of companies that have sort of been started outside of those hubs that have then opened offices in them. We have one company that has a joint Las Vegas and New York office, but that's sort of the only one that broaches that. None of them have gone to California, and I wholeheartedly agree with the comments about competition for talent and expense. And incidentally, we're now seeing, I know there's some mixed data on this, but we're seeing a lot of people actually leave the Bay Area and Silicon Valley for some of the reasons that Anthony described, but also some of the talent that is wanting to have, a more reasonable lifestyle, less extreme expense in the cost of living, and can still find great technical jobs elsewhere.
That's interesting. Michael, I know you focus on or spend some time in the B2B software world as well, and that's what I wake up every day thinking about. I would kind of maybe push back on Victoria's comment. What do you think about the statement that if you're selling B2B software and your first entry point are like-minded customers, right, or they're B2B software companies, is your entry point, and there's a lot of great examples of that. What do you think about those companies being started in other regions if you're selling an application to another application company?
Yeah. So a company that I worked with back in 2010 on through 14, a company called Toa Technologies. I don't know if you're familiar with it. It was based in Beechwood, Ohio, and they were selling kind of $1 million and up annual contracts, really hardcore B2B enterprise software. And the founders just wanted to be in Beechwood. They really liked Ohio. The technical co-founder was there, and his family was there, and they made it work. So I actually think in B2B software, because you can outsource sales teams, I think, much more efficiently. Sales teams, unfortunately, tend to leave companies with far more frequency than hopefully an engineer does. So you can put some of those hubs outside of where the company was founded, and that's what they did pretty early on both coasts and internationally. So I think it is more challenging. It's nice to walk across the street and walk into a customer's office and have that ongoing dialogue, particularly as you're building the product early on. But I think it can absolutely be done in the B2B sales model.
That's interesting. And what do you see in terms of the recruiting of executives? That's one of the things that we hear a lot and think a lot before investing in a company is how are we going to get experienced C-level people in this non-core region? Anthony, have you had companies have good experience with people relocating? What are some of the considerations that you have prior to investing about a company's ability to recruit people in?
Yeah, so that is one of the challenges that I listed on the slide, and I think that is the biggest thing that we run into and the thing that we try to help with the most when companies get to even a 10 million run rate scale is when they have to get that next layer of management in there. We've had to import. We have companies in Canada, up in Vancouver, where there's not a whole lot of senior management talent base, and we've had to convince people from the Valley to move up there, or in some cases commute. So it's a big lift. It's a lot of work to do that, but once we get them there, they do great, they stay, and it's just part of the trade-off.
As a counter to that, one thing that we found actually at the kind of C level, it's been easier in many ways. These people are further along in their lives, right? They have families and want to settle down. Whereas it's kind of the middle layer, folks with kind of 3 to 4 to 5 years of experience. It's challenging to get them to want to leave, an urban center, city center.
So we're obviously a small sample set of venture people. Why, and it's a select group in that we're here as well, why do you think are we just ahead of the curve, this group, we're the smart group that are seeing this thing that's coming down the line that others are going to come around to? Or why do you think some of these hurdles exist inherently in the venture ecosystem? Victoria?
I think, there's certainly Silicon Valley wasn't always as it has been. It used to be orchards, but you had sort of the cumulative effect of a couple big technology companies being based there. The talent grew around it. Certainly there's a lot of, the university ecosystem that supports continual infusion of talent. But I think that this is certainly a trend that a lot more people are paying attention to now. And I think for us, what has really driven us to make this a big part of our thesis is that it just doesn't make sense to us that the potential and great ideas are in so few areas and concentrated in such a limited pool of founders. So we think that we'll have outsized returns based on paying attention to a lot more opportunity than the very limited set that most dollars are going into. I think within the last 2 years, we've seen many more funds develop that are focused in regions outside of those 3 core markets and are started, some of them by people who locally are from those regions, but some that are, former Sequoia partners that are going to relocate in Ohio and start new funds. And I think that is the sort of identification of opportunity that before all of these markets get saturated with as much capital as is chasing as few deals in Silicon Valley and New York and Boston, there's going to be a lot of opportunity to have outsized returns. So the Buffett quote that, the best time to invest in something is when you're the only one doing it. I think a lot of people are trying to be the only one or the first ones into various markets to take advantage of that.
No, that makes sense. And Anthony, when you're looking outside of your core, outside of the Bay Area, one of the things that we've thought through is getting follow-on investors, right? It sounds like the group here are very willing to invest outside of the region, but that may not be true for everyone at the moment. Is that something that you think through, and how do you sort of bridge that gap as you look for subsequent funding for some of the businesses you invest in early?
Yeah, that's a great question. It is something we think about a lot because financing risk is one of the risks in starting a company that we actually have some control over based on how we, how we want to roll that out with the company. So I said earlier that capital is mobile, but capitalists are lazy, and that's generally pretty true of Silicon Valley. There are a class of growth investors and growth equity investors on the East Coast and the West Coast who are willing to go just about anywhere in the world now to find a company that is over, let's say, 10 million in revenue. So those are the set of people that we work with for that next round, and we have to kind of have it in mind. But to your earlier question, there's opportunity all over the place. Atlassian in Sydney, Australia, or Shopify in Ottawa, Canada. So those kind of opportunities have kind of woken people up in the valley, and they figured out that if they do want to find those opportunities, they have to go further. So we think very consciously about that.
And what about existing syndicate investors? How important is it for you that the company has a good support group of either angels or seed investors around the company? Michael, maybe speak to bellhops as a specific example, but was that a consideration for you?
Yeah, so I would say no. Generally, at the at the Series A, and maybe if you have some concern around first-time founders, maybe it's a little bit more important. But in that specific case, we came in at the Series B, and again, systems are in place. The company's humming along. We wouldn't be too concerned about having a local presence there. In that specific case, we actually did have the Lamppost Group, which was local, and I think a great resource for the company to just build and recruit. And there are little things that you don't think about early on that can be really challenging if you're not able to pick up the phone or walk across the street and grab coffee with 5 of your friends who all have their own startups, which is the case in the Valley or in New York. So I think it's helpful, and it's something that we look for within ecosystems in terms of maturity. One thing, I mentioned we're a bi-coastal firm. We're in San Francisco and New York, and we're constantly looking at New York as I'm in that office. In 2010, the top 25 deals in New York were led at the first round by 75% were led by New York-based investors, but the growth rounds were led 75% West Coast investors. Fast forward to last year, that completely flipped, and now the entire ecosystem in New York is self-sustaining, and you're seeing the growth stage guys come in as well. So ultimately, that's what you want to look for as the ecosystem within a city unfolds.
And it sounds like you're saying as you go later, and Anthony, you alluded to this as well, as a company gets bigger in scale, it's more likely that people will fund it. There's just fewer numbers of those companies. Is that fair? Is the bar just generally higher for you to invest in a company in Nashville, in Chattanooga, in Austin than it would be, I guess, Anthony, for Silicon Valley or Victoria, Silicon Valley, Michael, New York? Is the bar significantly higher? Is it somewhat higher? Is it about the same? How do you think about that, Victoria?
Yeah, I think for us it is, the bar is not higher. We in fact do very few investments in California and New York, so it's probably the reverse is true for us, that companies that are based in those locations have to be really compelling for us, and the valuations have to be reasonable enough, which immediately eliminates a lot of them. So for us, we are very focused on backing founders who have lived experience with the problems that they're solving, and that's why we have this emphasis on finding communities that we think are disproportionately well suited to address certain things, and we find that many of them tend to be in places that are outside of those markets, the core markets. So I think the bar is probably not at all higher for us, and your chances are better of getting into our programs and then getting funding if you are not based in California or New York.
Anthony, same question.
Yeah, I mean, while we do have a predisposition to doing deals outside the Valley, I would say the bar is higher just from the standpoint of the company's got to be far enough along that it doesn't need a ton of our help because we can't be here all the time. We can't be recruiting the exec from down the street. We can't be dropping into the office on a Friday to chat about stuff. So the company has to be further along. The core team has to be there. Product market fit has to be there. The sales machine has to be working. So I'd say, if we're looking at a $2 million run rate company in the Valley, we'd want to see a $3 or $4 million run rate company here. They're just that much more mature.
Michael, do you think about it the same way?
Yeah, so I probably fall into the similar camp. I wouldn't necessarily peg it to a revenue metric. I would say all of the other things have to be perfect, right? As we're going down the checklist, perfect, as close to perfect as we can get, right? Concerns around team, product market fit, so on and so forth. The things that actually aren't quantifiable, all of those things kind of need to check the box in order to get involved. I wouldn't necessarily say, a SaaS business at the A has to be 2x the number or whatever it is necessarily, but you have to have less concerns around the edges because of the proximity that you bring up. I think as early stage investors, you want to constantly be with your portfolio from C-level all the way down and just spending time with them, and it's tough. There are ways around it, but it's definitely tough when you're remote.
And what about people in the audience, entrepreneurs here, that are thinking through how we get you three to invest in their companies? What recommendations would you have outside of just building a great business that you would say to those people that are hoping one of your firms invest in them? Victoria?
Yeah, I think our piece of advice is always, rather than trying to get better at fundraising, build a better business, and that will make it easier to raise money. So certainly that's one piece of it. But I think one of the things, there's been a lot of conversation about different ecosystems wanting to figure out how they can be the next Silicon Valley, and that not being the right approach at all, but figuring out rather why you are uniquely positioned to do whatever you're doing. And I would give the same piece of advice to founders. So I think the main pieces of differentiation that you can highlight to an investor that will make them interested in learning more about your company are what results that you achieve better than anybody else trying to solve the same problem. And hopefully that's not just features of your product, but actually a way that you do it that is different and yields better outcomes. And I think one piece of that can be why you are personally motivated to work on it, either through experiencing whatever problem you're trying to solve yourself or having really close proximity to it. And then I think trying to figure out within your local network, if you're not at the stage where you're going to fly out to California or New York to fundraise, figure out what assets exist that you could be leveraging, whether that's non-dilutive local funding or funding from angel groups, or many states and cities are now setting up innovation funds or other facilities that are helping more startup and entrepreneurial activity get off the ground. And that can be great ways to sort of get through the initial test phases of a company so that you can then start attracting angel funding and seed funding.
Anthony?
I think that's great advice. Be yourself, right? You don't have to be like Richard and Ehrlich of Pied Piper. You do have to speak when you go to Silicon Valley, as Ken from Squid said yesterday. There's a certain vocabulary, language, way we want to see things packaged when we talk to companies. So I think that is important. In terms of how to get to us, the best way to reach us, aside from email, is through an entrepreneur reference. That's the best, someone we know who's a great entrepreneur. If you can get a reference through them, that's the best way to network to any investor, I think.
Yeah, I think that's spot on. One of the things that I mentioned this before, Cameron Duty at Bellhops is, again, one of the best recruiters I've ever seen. Having that faith going into the deal really helped tremendously. It was something that we were a little uneasy of going into it. And so focused on that. I think the other thing to focus on is, play to your strengths. You can raise a round and have, instead of 18 to 24 months, which is usually what we're raised to, show us a plan that has 3 years of cash, right? That's real value. Things take a long time to build, and that's real value that you should definitely focus on.
That's great. Okay, so I'm taking away Silicon Valley's overrated, and there's a lot of opportunity elsewhere. Good. Maybe we open this up to the audience. I know we have microphones somewhere around here. If people have any questions for our esteemed panelists, don't be shy. I see one back.
How do we get firms like yours to open offices in Nashville or other places like that, the VCs themselves to actually come here, or to change the institutional investor environment here so that it's more friendly to startups?
Michael, you want to take that?
Yeah, I think getting folks to open an office will be challenging, quite frankly. I think you alluded to Drive Capital earlier, which was, I think, a fantastic example of, really experienced Valley investors who moved outside of the Valley specifically to invest in companies off the coasts. I think having conferences like this to bring folks together is a great thing, and really try to get individual investors to come out. Another thing Bellhops did, they encouraged us to come out every step of the way. 2-3 calls in, hey, come check it out. We're 2 hours away. Come see the office and the space, and you really kind of get a sense for the community and the culture, which should be huge selling points for your investors. So, I think getting somebody to open an office is maybe a long-term goal, but in the short term, really, events like this I think are great.
Yeah, I would say there's only two, there's the lifestyle and then there's the ecosystem, right? So either you have better companies or you have a better city, and I think having all of them would be great, but I echo a lot of what Michael said. I think we got one back here.
Microphones will be awesome. So I actually used to be in the West Coast and was involved in Boyne Ventures and venture capital. As a whole, decided to move to Chattanooga because I loved the lifestyle, and frankly, the weather was a lot better. We built a startup. We have been profitable for 9 months. We have profiles on half the population of the world. And when I meet, we end up fielding calls because I realized raising capital is just a full-time job and I don't have the time. We have to get profitable. But when we field calls from well-known funds, they come up with 2 things. One is, well, we haven't, or 3 things. We haven't seen any home runs come out of the Southeast, which I don't think is true. The second thing that they come back with is, well, we don't see how you're going to get to $100 million valuation, which part of my Latin thing is, well, how many companies do you have that have gotten a $100 million valuation? And then the third thing is, well, we want to see who will lead the round. And so part of the challenge is finding somebody who can lead a round that can bring other people to syndicate. I've got 3 funds who say, we'll syndicate, but we need you to find a lead. And I don't have time to find a lead because it's easier for me to close a deal than raise capital. So what advice do you have for those who having been in the West Coast, you've done, okay, we've checked all the right boxes. But the reality is, I can hear all you guys want about, yeah, we're looking outside, and few funds are doing that. But the bulk of the funds are like, I've been told by a fund, look, I got to travel to New York, Austin. I don't want to fly down to Atlanta, much less Chattanooga. And so what advice do you give companies that say, do we just say, screw it, and we'll just focus on revenue it's very frustrating when you're turning down business because you can't get to it. So what advice do you say, how to find that lead who can drag the rest of the people over? Does that make sense?
Yeah.
So I'll say, it sounds like you're talking to the wrong people. Because the first thing you said about, we haven't seen any big hits, that's BS. The second thing is legit. I think we always ask companies, how are you going to get to 100 million in revenue? And you have to show us a path there. That's incumbent on you. If you want to raise venture capital, to show that it is a venture-sized opportunity. Otherwise, I would say don't raise venture capital. Venture capital is a hassle. It's a pain in the butt to have people like us on your board, calling you up all the time, asking you how you're doing. Your plan A, your default plan should be get profitable. But if you see a path to 100 million in revenue, and if there's a capital need to do that, then venture capital is something to think about. And then the third thing you raised about, hey, we don't want to lead, we just want to be a syndicate partner. Again, you're talking to the wrong firms there. So there's a handful of firms, I think all the ones here on stage, who are willing to lead something without a local partner, but you do have to show that second thing.
I would also push to get sometimes there's a fair number of venture platitudes that are almost like a soundboard that people will go to say no without being as nice as they possibly can. So I would push to get like as actionable feedback as you can, because a lot of those things are either, to Anthony's point, false or probably easily overcome.
One more.
Yeah,
Well,
one
you guys
up
were
front.
you guys were not this quiet at the hockey game last night.
Still hungover.
You just- Just to restate the question, it's what do people like to see in terms of competitor analysis from a startup?
I think a realistic view of who that set is, and then again, as I mentioned, on how to focus on what differentiates you. And I think the flaw that we see startups often go to is focusing on like features or price, which are not lasting differentiators, rather than results. So how do you actually do something to solve this problem that is better than what all of your competitors do?
I think being honest about it, like there's only two really competitive charts people do. It's either the Harvey balls, where you have all of the full balls and all your competitors have like a quarter moon or whatever it is, or it's the T chart that you're up in the right and everyone else is bottom left. If you think that's really the market, then we can probably have a short conversation.
I would just like to make the observation that venture capital has been around long enough where there are some ecosystems, and I would say do your research to find the one that fits your idea, your product, your service. For example, Silicon Valley probably still is the destination for a pure tech app, something like that. But if it's in the fine tech world, fintech, financial technology, you want to go to Atlanta, Georgia. Atlanta, Georgia is now the absolute undisputed center of financial technology with Equifax and the other people there, Visa and MasterCard. So I would do your research on ecosystem. It's just not about New York. It's not just about Silicon Valley at all.
All right, I think we're up on time. I don't know if we have time for one more. Let's do one more.
Thank you. Victoria, you touched on ag investment, and given that Tennessee is a hugely agriculture-based state, I wanted you to talk a little bit more about ag investment, how you approach that, and if any of you are in that arena, if you could touch on that briefly as well.
Yeah, so it's certainly been a focus of our work in this region. Most of the agriculture programming and investing that we have done has been focused on sourcing companies here, bringing them into close engagement with customers who are based here, and then also bringing them to Davis, California, where we leverage the ag school at Davis. So I think there's a lot more opportunity that we see regionally to focus here in the Southeast in terms of ag, and we have a couple great co-investors, Radical Capital out of Kentucky, Access Ventures, that have done deals with us on that realm. But I'm seeing more interest in the Bay Area to actually come to our ag work in Louisville and elsewhere. So again, I think this trend of not just local sources of capital, but people starting to pay attention from elsewhere is continuing to develop. So stay tuned, and I would love to talk about what you're building here if it's in ag.
Great. Okay, well, I think that's time for us. So thank you, everyone, and thank you, panelists, for joining us.
Thanks.